All right, thanks everyone for jumping on. We'll get started here. Everyone's on time, so that's great. We'll just let a few more people come in and we'll get started. I'm trying out this new thing where the default is, cameras off, mics off, but if you want to have your video on, please do, so it doesn't feel like I'm just talking to myself. I tried it the other day and it was, not as fun as even though, yeah, it's just a little bit more fun to see everyone's faces. So if you want to have your video on, fine by me. Also, if you want to interrupt me and ask questions during, go ahead. Hey guys. Yeah, so go ahead and ask questions during or in the chat or by unmuting yourself, and we'll take it from there. I don't have anything prepared here as far as presentation or a certain agenda. I'm just going to literally pull up the spreadsheet on our current deal that we're closing next month, and we're just gonna dive into the numbers and expose myself a little bit as we stress test the deal. But I feel very confident about this deal. I'm really excited about it. So I think we'll be happy with what we see. So let's dive in. I'm going to open up the spreadsheet. Okay. Okay, perfect. Let's do this. Okay, so this is our underwriting spreadsheet, as I'm sure many of you guys have seen it before. I'm just going to try to get the window optimized here. So this is our current deal that we have under contract, Broadstone Briar Forest. It's a 342 unit deal in Houston. If you want to learn more about the deal, because obviously I'm not going to walk through the business plan and all that. We're going to focus on stress testing and sensitivity. So really the numbers here are just for modeling purposes. But if you are interested in learning more about this actual deal, you can check out the webinar that we hosted for it a couple weeks ago. That's a private video, unlisted video on YouTube. So if you haven't gotten the link for that, just message me, or maybe I'll even just put the link in the chat here if you want to check that out to get some more context later. So let me just grab that link real quick. And obviously we also have if you prefer to learn with a pitch deck, then I can also send you the pitch deck. For some reason, I'm not seeing the chat. All right, here we go. Okay, sorry about that. Okay, so yeah, so this is a 342 unit deal in Houston. It's a very typical value add plan that we have here. Something that you don't see quite as often is the 3-year hold projection. This is something that we do for bridge loans, which is an interesting nuance and something that we'll be spending a lot of time talking about, since bridge loans are a major source of risk in today's environment. Really, bridge loans always are an added risk, just given the shorter time frame of the loan and the higher leverage point. A lot of people talk about the higher interest cost of a bridge loan, but really that is the least of your worries. It's the far bigger concerns are the maturity factor and the higher leverage. So the reason why we do the 3-year hold is because the initial term of the bridge loan is 3 years. And so that matches up better than trying to forecast a 5-year hold, because then you're running into issues of, are we essentially planning to use the extension options on the bridge loan? Are we going to refinance and then hold for 5 years? So it's been an educational process to kind of tell our investors that, hey, we're projecting a 3-year hold, but we might sell or refi in 2 to 3 years. And if we do refi them, we're going to likely hold for 5 to 7 years. So that's our kind of framing and narrative for this type of business plan where we're going with the bridge loan. So let's dive straight away into the sensitivities tab. So everyone's got their own sensitivities, and there's There's nothing right or wrong. There's some kind of more traditional things that we'll cover, like the occupancy, break even and things like that. And then this exit test is kind of the king when it comes to stressing stuff, especially bridge loans. And an exit test, this might be small for you guys, so I'll make it bigger. The exit test is, in my opinion, the most important thing to look at, because this is determining whether you're going to have an angry lender when the loan is due, or if you're going to have to make a capital call, and that's where issues happen. So, typically covering shortfalls in cash flow are not as difficult to do than actually having a maturity of, okay, you need to pay the lender back 40 million bucks. How are you going to do that? Are you going to do it via sale? Well, maybe being forced to sell at that point in time is not good because the market's not there, the property's not there. So you don't want to be forced to sell, right? Being forced to sell is one of the ways to lose money, and being forced to refi is not as bad. So that's why we focus on a refi exit test, because if we are forced by the maturity to refi, we can live to fight another day, right? Price is permanent, financing is temporary. We can, it's a way better outcome. So looking at the exit test, I'm sure, many of you have seen it before, many have not. So I'll just cover the basics of what it is, which I kind of just described, which is the loan is due and you need to refi to pay off the loan. And you need to kind of see what position is the property in, what kind of loan will the property qualify for to pay off the loan. Simply, in just a static environment, if we're going to take an 80% loan to cost bridge loan, right? So we're getting 80% of the purchase price and we're funding the CapEx. And I want to refi out of that with a loan that's just going to be 75% loan to value. That already means that I need the property's value to go up by maybe 20%, 25% in just a static environment to go from one loan product to the other. So that goes back to the bridge loan and why bridge loans are a source of risk and have to be accounted for because of that higher leverage point. Can you go bridge to bridge? Absolutely, right? You can go in on a bridge loan, and for whatever reason your loan is due and you have to refi, you can find another bridge lender to bridge you to bridge. And again, that's another way to live to fight another day. So you don't have to go from bridge to permanent, but that's kind of the typical thought process. And then when we stress or do this exit test, that's what we're assuming. And so base case, so we're looking at this deal, right? And I'm setting this up 60 months out in the future, because while it's a 3-year initial term bridge loan, there's 2 1-year extension options for a total of 60 months of term. So the lender is going to give me leeway for 60 months. Yeah, I might have to pay a little fee for those extension options, but again, I'm living to fight another day. And even at the 60-month maturity, you may be able to get something from the lender. You may be able to say, hey, I'm jammed up. Can we extend? Can we do a mini extension for 6 months? Can we get a third extension for a year? And they may say yes. Conversely, there's a lot of language in these loans that could allow the lender to opt out of an extension and not grant it to you. It's not something I'm actually, I'll admit, super familiar with. I mean, I'm familiar with some of the other tests that the loan has as far as DSCR, loan out of balance guarantees, and kind of things like that. But it's actually a good thing that I will look into after this. Now that I've brought it up for myself, is what are the lenders outs to not grant me those extensions? Because these extensions are material. Because if I switch this exit test to being a 36-month test, you can see this deal fails the harshest exit test. If I go to 60 months, it passes, because the passage of time, assuming things are going well, you get more rent growth. If you're amortizing, which this loan is not, then you're paying down the loan. So that's good. You get the benefits of amortization in certain cases, but we'll stick with the 60-month test for now. And we'll look at the base case. In 60 months, our base case NOI is 3.4 million. Life is great. The property's worth 72 million. At 75% loan to value, we can get a $54 million loan and easily pay off our $43 million existing debt. So not a problem. And the cash flow is great because our debt service coverage ratio is 1.5 in this base case scenario. If you're not familiar with debt service coverage ratio, that is your NOI divided by your amortized debt service. So principal and interest payment. So even if you have an interest only loan, you would still calculate the DSCR via an amortized debt service payment. So you can see lenders are typically looking for 125 minimum DSCR. So this property should have no problem getting a 75% loan to value loan here in this base case scenario. Now let's go to the operational shock, which, to be fair, this is not a big shock. Bigger shocks have happened, but it's a 5% shock to revenue, which is resulting in a 9% decline in NOI. So 9% decline in NOI, that's certainly not the world is ending, but it's a meaningful impact. So now we go from 3.4 million NOI to 3.1, and that means the property's worth 65.5 million. And we're using, I believe, a 5% cap rate to calculate this value, in case anyone's wondering. So again, at 75%, that's a $49 million loan. We're still paying off this loan, no problem. And, in this case, we're living to fight another day, right? Maybe this isn't the refi that we were dreaming of, right? We wanted to get the $54 million refi, but we're only getting 49, but we're living to fight another day. And we have cash flow. Again, good metrics here, good loan metrics. Now, this next shock has nothing to do with your NOI. Life is good, the property's performing, but the market has worsened. So what I mean by that is interest rates are up, cap rates are up. So you can see here we're doing interest rates are now increased by 25%. So we're assuming a 5% interest rate environment, and then the cap rate increase. Oh, so I'm sorry, we're actually using a 4 3/4 exit cap rate. So a 5% increase, we're going from 4 3/4 to 5 cap. It sounds like a small move, but it's a big move. 25 basis points on a cap rate is a lot of value. As you'll see here, it's actually not as big as I thought. It's and the resultant loan amount just changes by $1 million, and that's because of this. Hang on, I'm sorry. So in the base case, it's $54 million loan, and then this is going down to a $48 million loan. So it's about a $5 million difference in loan. So it's meaningful, right? That 25 bips was $5 million in loan difference. I'm sorry, again, that's wrong. It's not just because of the cap rate. It's also because we're backing down leverage from 75 to 70, right? We're assuming the market is worse. Lenders are not willing to give 75. They're only willing to give 70. So we're being conservative. Let me just see for myself if it's 75, 54, 51. So 2.5 million is the difference in the cap rate. So again, if you don't have this spreadsheet, this is totally available to you. So reach out. If you are on our investor list and got, an invitation to invest in this deal, we have the data room and all this, these documents are available. We provide our spreadsheets to all of our investors. It's not even by request or anything. It's just, here you go. So for maybe for you think we're being wimpy and, this cap rate increase should be a 10% increase. Go ahead, stress the deal. And maybe the revenue should be 10% as well, and continue to stress the deal. This is, these numbers are to be absolutely played with. So that's the capital market shock. The other thing to point out on the capital market shock is the 139 debt service. So, we're not talking about cash flow here, right? NOI, but it's NOI is pre-debt. So there's no cash flow discussion here. So why are we even talking interest rates, right? Why are we stressing interest rates if we're not even talking about cash flow? Well, that's because of the DSCR, because lenders don't just look at LTV for sizing the loan, they look at DSCR. And these days, because cap rates are so low, 99% of deals are constrained by DSCR, not by LTV, right? The value is there, but you're not going to get to 75% loan to value, or even 70 in many cases, because the cap rate is just so low, and therefore the DSCR is the constraining factor. So if interest rates went to the moon, which is only 6%, you would see the DSCR is low, and we wouldn't be able to actually get a 70% LTV loan in this case, because the DSCR is below 125. not terribly difficult or uncommon to get an exception to this from the lender and get a 120 DSCR requirement, but we may have to back this down to 65% leverage to pass the DSCR. So you can see in a high interest rate environment where interest rates really go up, our loan is going to be constrained again. And now we're talking about a $44.5 million loan to pay off a $43 million loan. So it's getting tighter and tighter as we stress. But I'll go back to our original numbers just to keep things consistent. And now finally, the both scenario is just putting them together. The operational shock, so your NOI goes down, and then also capital markets are in a worse condition. So interest rates are up, cap rates are up. The unfortunate irony about the cyclicality of markets is typically they do happen at the same time. Typically an operational shock happens and then the capital markets freak out about it. So you have worse capital markets environment because of the operational shock, and combined you actually have problems. You actually have real problems on your hands. So you can see in our scenario where our NOI is worse, our cap rate is up, the property's value is only 62.5 million versus the base case of 72. And that means our new loan at 70% LTV is only 44 million. And still enough to pay off the existing loan, which is what we care about, but it's tight. And obviously we can easily make this fail. If the shock is worse, fail. If interest rates are higher, it'll also fail because it won't get this 70% LTV loan. It will be 65. This is wrong. This needs to source from this. I'll make a note to fix that. Okay, so now that we've stressed the deal some more, you see we have a $36.5 million loan versus our existing 43. So what do? Right, this is a major issue. You can't pay off your existing debt in this scenario. So what do you do? The answer is, one, in many cases, people in this situation are forced to sell, and this is the worst thing to do. Right, we can't pay off this loan with the new one, so we actually have to sell at 56 million, which is not what we want to sell for, right? Because we know in a good environment we should be able to sell for 72 million. So we're leaving a lot of money on the table. Still making money, which is good, but this is not what you want to do. So instead of a forced sale, right, what you would preferably do here is, again, live to fight another day. And that would mean making a capital call, which is not easy, a lot easier said than done. So what that would look like is your partnership would actually have to post the difference there of about 6 million, would have to post $6-7 million of fresh equity into the deal in order to put this new $36.5 million loan on, and then get the new equity on top of that to pay off your existing lender. Now you've diluted the original partnership with the fresh equity, but you're living to fight another day. The other option is to go bridge to bridge, right? We don't have to go do a 65% LTV perm loan. You could do another bridge loan, and bridge loan could get you 80% and more potentially, and now you're good. So these are the downside scenarios and the measures that need to be taken in order to just not be forced to sell, right? And obviously what's even worse than being forced to sell is a foreclosure, right? You say, hey, the lender says, hey, $43 million loan is due. And you say, sorry, I don't have the money. And then they take the property. That's the worst scenario, but we're not, we have many tools at our disposal to avoid that. So I kind of just jumped right in to, the most important thing, which is the exit test, but there's a whole lot of other stuff. I kind of maybe should have built up to this one. It's the most exciting and interesting, but I'll pause there. The chat is very, not happening right now. So if anyone has questions, put them in the chat or unmute yourself, and we can cover some more things about this before moving on.
Hey Rob, Jenny here. How you doing?
Good.
Can you hear me?
Yes.
Oh, okay. Yeah, that was like I felt like I was riding a bike to catch up a little bit, but interesting because I haven't had a chance to play with the spreadsheet that much yet. But I love the fact that you can do the changing the numbers just mainly through that one box. And I guess my spreadsheet, the one I saved, also needs to have that 65% or whatever fixed. It has a error
Wrong
sign coming up in
reference.
that cell.
Mhm.
Um, but no, that's terrific. Please do go ahead and explain all the things that you wanted to address on this because it's a great spreadsheet. I like how robust it is.
Thank you. And yeah, something that I'll be saying till the end of time is that all the inputs are unlocked. Even though that all these tabs here have a lock, they are able to be edited. So anything that's supposed to be able to be edited, it can be, right? But I always send the spreadsheet out and then people say, can you unlock it for me? It's all locked down, but it's completely unlocked. The lock is to protect the spreadsheet and to protect users of the spreadsheet from accidentally making kind of overwriting formulas and breaking things, right? So just kind of to go to the inputs tab, if I wanted to change something like this, I can't because it's blocked, it's locked. But something that is changeable, like, hey, I want to change the 1-bedroom rents from 1,000 to 975, it's perfectly unlocked. So that's the methodology or the reasoning why things are locked, but actually unlocked. So it's, for our internal use, we keep these tabs locked 99% of the time. It just keeps us safe, and we can still do everything we need to do. So that's just another
Rob,
point.
can I ask a question?
Sure.
Yeah, do you keep them locked while you're underwriting, or whoever does the underwriting?
That's right.
Okay.
Yep. So yeah, there's not many circumstances where you really need to unlock. So yeah. So let's
Hey
see.
Rob, did I just miss
Sure.
how you unlocked it? Did you just show us how to unlock it and lock it?
Yeah. So it's a review tab here, unprotect sheet, and then it unlocks it. And then I just locked it back to protect sheet. There is no password, right? I could set a password. I could protect the sheet, set a password, and then do that, but I won't do that. So yeah. So Penn in the chat is asking about the operational shock. Is that due to execution issues or like a shooting in the neighborhood? So it could be anything you could be wrong about your business plan, and that could be technically a shock, right? You projected to get a certain amount of NOI and actually less is happening. Could be anything, could be, property specific, it could be market specific. But that does bring up a good point, which is the fact that a temporary shock it's a big deal, right? You have to address it, you have to live through it. You're going to have worse cash flow, but really having temporary worse cash flow is not what this operational shock is about, right? For this purpose, we really don't care that cash flow is weakened for a period of time. What we care is that cash flow is weakened. Jenny, could you put yourself on mute, please? You're fine. So we care about the fact that the NOI is weak at the critical moment in time that the existing loan is maturing, and that's what our value is going to be based on, right? This is a value-based stress. We don't really care about the shock that it's having to cash flow. Yes, if cash flow gets wiped out, that's terrible. We want to have positive cash flow. It's a risk mitigant, and it's obviously the reason why we're here investing in the first place. But it's not the thing that we're focusing on right now. We're focusing on how operational shock leads to worse NOI, which leads to lower valuation. So we have a question about going bridge to bridge, and the second lender takes the in-place LTV, or will they take the future value and still lend on total cost? Yeah, I mean, they could absolutely lend on a cost basis. And right, they're still going to get an appraisal. And so they're going to be held to an appraised value. And it's a as stabilized appraised value is what. So, I mean, bridge loans are constrained by various factors. And it also just depends on the lender. A lender can come in and say, I don't care about any of these constraints or factors, and I'll just give you whatever loan. That's kind of the bridge loan world. There's more flexibility. But typically, bridge lenders are going to look at the going in debt yield, which is the NOI divided by value. I'm sorry, the NOI divided by loan amount. So that's the debt yield they're looking at. 4.5% debt yield going in, that's what they want. And then they want to see a stabilized debt yield of 7%. Similarly, on the cost side or the value side, they want to see that the LTV based on the as stabilized value is anywhere from 65% to 75%. And that's the lender explicitly basically saying, we want you to be able to pass the refi exit test, right? So when the lender says, I'll give you a loan of 100 million today, but I want this loan to equal 70% loan to value on your future value, they're making an explicit statement that, in the future, you should be able to refi us out using a 70% LTV loan. So they're looking at future LTV, they're looking at in-place value and cost to also calculate the loan. So there's all these different constraints that they're coming to for determining the loan amount. So bridge to bridge, lots of flexibility. But again, if you are going bridge to bridge and it's not a idiosyncratic reason for it, like you just at the property level have issues and you need more time. If it's a market issue, right, bridge to bridge can be harder. When the market is upside down, lenders are going to be much more conservative. Okay, one more question, and we can keep answering questions all day, but one more question before we maybe jump into a new topic. So in a rising interest rate environment, are we underwriting a much higher exit cap rate as your base case based on the projected interest rates at the time of exit, and then stress testing that cap rate? So that's a great question, and the short answer is no. If we were to, if you were to, I'm loving the opportunity to break this down philosophically. If you were to hold the opinion that cap rates were going to go up a lot, and by a lot, I really don't mean that much, but if you thought the cap rates were going to go from, today they're like mid threes, low fours, and you thought they were going to go to 6, which they've been 6. And if you thought they were going to go to 6 and you were going to underwrite deals based on that assumption, you would buy nothing. You would, and again, I'm not talking about tertiary markets because yes, 6 caps exist somewhere out there, but we're talking about major markets, major deals. 6 caps don't exist. And if you're projecting 6 cap exit cap rate, your underwriting is going to look so badly and your projected returns are going to look so badly, you're not going to be competitive on price and you will buy nothing. So essentially you can't have that view in your underwriting and still project out and buy deals today. So that is why we're just doing our standard exit cap rate analysis and underwriting, which is essentially widening the exit cap rate by about 50 to 100 basis points over prevailing rates. So if cap rates are about 4% today for a given market and deal, we'll use a 5% exit cap rate, something around that as far as our logic. So hopefully that makes sense. Kind of harsh, because everyone loves being conservative. Everyone loves talking about how smart they are. But the reality is we can only be so smart. The numbers are the numbers. And if we're holding a view that cap rate's going to be much higher, it's very destructive to value. And it's like, you just wouldn't invest at all. So that's the tough thing. So everyone's, kind of gets me passionate and frustrated when investors they ask me, how are you accounting for rising interest rates in your deal? Or, how are you accounting for cap rates are sure to go up because interest rates are going up, right? It's like, well, not really, but maybe, but we're also not interest rate forecasters. We're not bond traders. We're not making investment decisions based on macro things like that. Our job is to find good real estate to buy it, manage it well, And if the market experiences a large regime change or shift in cap rates, it's going to affect everybody, including ourselves, and the values of our properties are going to go way down. But we can't invest assuming that. So we have to carry on. That brings up an interesting point, which, go ahead.
So the 50 to 100 basis points, is that whether or not it's a 3 or a 5 year hold?
Yeah. It's not, we don't think about it in terms of time. That's kind of a classic assumption that, oh, well, you should increase your cap rate 10 basis points per year. And that's really more so based on the logic that real estate deteriorates over time and gets less valuable, right? So if you buy a property that's built in 2015 and you sell it 10 years from now, that's going to be the equivalent of a 2005 property today. And so 2005 properties are worth less than 2015. So that's the logic. But it's not, on a 10-year hold basis, especially new property, that makes a lot of sense, right? If I'm buying a 2020 deal today and selling it 10 years from now, it's going to be a 2010 deal, right? Equivalent. And that's meaningful difference. Now, the difference also is in the fact that the market's going to be in a substantially better place in 10 years, and people are going to be paying way higher rents. And so you're probably going to sell your deal at a lower cap rate, not a higher cap rate, because you're going to have a value add buyer come in and say, oh, well, look at this old deal. I'm going to spruce it up and add the latest frills, and they're going to raise rents. So they'll pay a lower cap rate for that. So yeah, so we don't get caught up in the, there's properties that are 100 years old and they're Class A properties, and they're not necessarily being penalized for their age. So that 10 basis points per year, in my opinion, is not that relevant.
So Rob, why are you, sorry to cut you off.
No, you're fine.
So why are you underwriting to a higher cap rate on for your exit, if you know what I mean?
Yeah, great question. So the reason for that is, I hate to say this word, but it's to be conservative.
Yeah.
It's just standard practice. If you don't do it, you will be penalized for it. Like, I can't bring a deal to investors and say, well, we're just underwriting the cap rate of today. That's not that's just not the norm. That's not general practice. So it's not what we would want to do.
So how come some investors they underwrite, like on their exit, they put a lower cap rate than what the market is, if you know what I mean? Like some investors, they look for a 6 cap, and then their exit is like a 5.5 or a 5, whatever the case may be, if you know what I'm trying to say.
So that's a really good point. There are many reasons why you can buy a property for a higher cap rate. So what you just brought up is the difference between market cap rate and the property's cap rate. So property cap rate and market cap rate are not the same. So I always give this classic example. If you're my friend and you're a really good friend and you have a deal in Phoenix that you could sell for a 3 cap or 2 cap even, honestly, but you're a really good friend and you sell it to me for a 5 cap and I buy it from you as a 5 cap. In my underwriting, am I going to use a 6 cap exit or am I going to use a 4 cap exit? All right, the answer is I'm of course going to use a 4 cap exit because it's Phoenix. People are going to pay me a 4 or a 3 or a 2, right? So it doesn't matter what I pay. It matters what the market is willing to pay. So it really doesn't matter what cap rate you buy for when doing your exit cap rate analysis. Another reason why you would have a higher cap rate going in than the market is a loan assumption, right? Are you willing to pay the market cap rate for a deal where you have to assume the existing loan, and the existing loan is a 5.5% interest rate and low LTV and amortizing is just an ugly, bad loan? You're going to get a discounted cap rate for assuming that bad loan. So you might pay a 5 cap for that deal in a market where deals are trading for 4 because of the debt, which is a great strategy, by the way, because again, price is permanent, financing is temporary, and in some cases it can make sense, but it requires patience and being willing to forego cash flow to optimize total return. But I wanted to go back and talk about this topic that we were kind of covering with rising interest rates, and how I was saying investors, they say, oh, hey, what are you doing to protect against rising interest rates or rising cap rates? right? I mean, and there, there's good answers that you can say. Of course, well, we're being conservative and look here, there, and this and that, why this is smart and safe. But at the end of the day, there's nothing that we can do, right? There's nothing we can stop. We can't stop cap rates from moving. But the other philosophical discussion about this is we're talking about macro things to make micro decisions, and that's a flaw here. Not always, but in this case, right, we're arguing macro things like interest rates going up to make a micro decision of investing in this deal versus this deal, when really that's flawed because both of those deals are going to be affected by this macro. So this macro thing is not a differentiator between these two deals, because cap rates are going to affect, if cap rates go up, it's going to affect both of those investments. The right thing to think about is this if cap rates were to go up, is this investment better positioned to withstand that? Or better yet, is this market that this property is in, or this property in particular, is it going to see a lower cap rate move, right? Is this investment less volatile than others, right? For example, people have different opinions, but I would argue that tertiary markets, small markets, less than 100,000 population, are going to have more volatile cap rates than major markets, like all the brand name markets that everyone's investing in today: Phoenix, Dallas, Denver, Tampa, Houston. Those, I think, are going to have stickier cap rates. So that would be a good argument, right? You can say, well, hey, there's nothing that we can do if cap rates go up, right? It's going to affect our property. But we believe that we're investing in a market that has a lot of growth, a lot of demand, favorable supply and demand, and therefore the cap rate is going to be stickier. We're going to be affected less. If cap rates go up across the country, we're going to be affected less. So that's the right way to say it. You can't say, oh, this is a bad deal because I think interest rates and cap rates are going to go to 6%, right? Because, well, it's like, well, what are we talking about anyway? There's no reason to invest in any multifamily if you are a doomsdayer. So that's another philosophical thing, kind of harsh, sorry. Okay, another question is, if you buy a distressed property for less than it was purchased by the current seller, would the taxes be reassessed and go down, or stay where they are? It really depends based on where you're investing, and each county is specific. You can absolutely get them reassessed down. You don't even have to do it on purchase. It could be done, during your ownership, in a normal course of business. Like property taxes in some cases went down because of COVID, because people were saying value was going down in 2020 because of COVID. I mean, it didn't happen a lot, but at least property taxes stayed flat. That was nice. So yeah, that's a fair question. Okay, cool. So hopefully all that was interesting stuff. Definitely kind of got a lot out of my head, got it off my chest. So we covered the refi exit test, and now we'll touch on the break-even occupancy stuff. Super simple metric. Everybody talks about it, but I think the funny thing is a lot of times we don't know what we're talking about. And also, how are we calculating this? Because if you just ask me, what's the break-even occupancy, and I say it's 80%, how did I calculate that? What am I talking about? So, and I think we recently updated this to make it a cleaner formula and whatnot, but because we kind of had a very harsh break-even occupancy calculation where it was very rigid, and we weren't counting loss to lease, and we're really just honing in on physical. So that's that. I'll keep it simple and just kind of talk about break-even occupancy, physical versus economic, right? Both are valid, but you have to know what you're talking about because they're substantially different. So when you see break-even occupancy, I would argue most people are going to be showing you economic vacancy. Why is that? Well, you could make the argument that it's more accurate, and also it looks better, right? Because economic break-even occupancies are lower than physical. So, it's better to be able to tell your investors, hey, the break-even occupancy is 70% versus 80%, right? 70% sounds a lot better. So what are those, right? So physical break-even occupancy is just focusing on actual vacancy from a heads and beds standpoint. It's not factoring in bad debt. It's not factoring in loss to lease, concessions, right? We're just honing in on the heads and beds factor of vacancy. So true physical vacancy. And then economic is factoring in all losses. So economic vacancy is just basically effective losses across the board from loss to lease, concessions, employee units, bad debt, and vacancy. So you want to know what you're talking about. One is different than the other. So that's pretty much all I wanted to share about that. So if you're kind of, talking about break-even occupancies, you should actually look at what it is. I think it's kind of a nice, clean way to talk about break-even, but it's just really not super helpful, because most of the times you're looking at deals and you look at the deal and it's historically been just 90% plus occupied, and then the break-even occupancy is 70-80%. So it's not like it's not so volatile that break-even comes into play unless you're doing some sort of reposition stabilization play, and at that point it's not that relevant. Break-even. So the other point I need to make is occupancy stress testing and break-evens. This is a cash flow focused stress, right? We just spent so much time on the refi, and that was a value stress. Now we're talking about cash flow stress. And this is more applicable to longer term holds, right? Because we're focusing on, okay, we're holding this deal for a long time and we want to know what the break even is. Because if you're holding a property for a long time, at some point during your long hold period, something bad's going to happen and you're going to have a stressful situation, and you want to know what your break even is on a cash flow basis. But with that being said, also, you should have enough reserves in the account to cover if you do have negative cash flow for a period of time. Certainly not indefinitely. Obviously, that's not possible. That would be a capital call scenario, but that's what we're focusing on. So the way I look at it is the occupancy stress test is looking at more of a longer term hold scenario and stressing that. And then the exit test is looking at shorter term hold scenarios and stressing that. That's how you want to focus on it. Or that's which scenario to focus on when. Okay, happy to kind of dive deeper into that, but I just wanted to cover that really quick. And then we're going to finish on these sensitivities tables. And everyone has them. They're good to look at. And in my opinion, I don't think they're terribly insightful. One thing I do want to point out, though, is the difference between the 3-year and the 5-year hold. And you can see for us, we're projecting a 16.6% return on this deal. And if we were to do a 5-year hold, all we're doing is changing the years. We're not changing financing. We're not assuming a refi, right? We're just going to extend the hold. The IRR goes from 16.6 to 15.2. And that's obviously due to the time value of money being more, when you sell sooner, you're shifting dollars to, closer to the present. And that's increasing IRR. But it's not a big difference. We've gotten some pushback from investors that are more used to 5-year holds, and then we're underwriting to 3. Their argument is, well, hey, you're already underwriting a 3, so there's not the upside potential of projecting 5 years and then selling in 3, and then that's your upside, right? So you can more easily outperform. But we're not talking a big move here. We're talking, 1.4% IRR difference. It's a big difference, but it's not like, oh, well, we projected 15 in 5 years and then we sold in 3 years and we knocked it out of the park with a 30 IRR. That's happening, right? We're selling a deal right now that we projected about a 16 over 5 years, and we're going to sell and investors are going to get over 30 on a less than 3-year hold, right? But we didn't knock it out of the park and deliver a 30% IRR for investors because we sold sooner. That has partly to do with it, but it's really just because we majorly outperformed on the rents and the cap rate, right? We were really wrong about cap rates, right? We did our normal thing, which is to take the market cap rate, expand it out, but cap rates compressed instead. And then that's why we're achieving a 30% return, not because we sold faster, right? That's a small difference in the makings going from 15 projection to a 30 realized. Okay, Ginny, go for it.
I was just going to put my hand down because I got sidetracked with what you were saying.
That's all right.
What
I was
was
on
I
a
going to
roll.
ask?
Sorry.
Yeah, yeah, no, that's okay. Keep going. That's all right.
Okay. Yeah. If it comes back to you, just unmute yourself and interrupt me. We're almost wrapped up here. I have a question about, is there a max break-even occupancy that concerns you? Yeah, a break-even occupancy that concerns me would be one that is, within striking distance of 90% or of what is normal for the deal, right? If the deal is historically at 95 and the break-even is at 90, that's tight. That's very tight. I would want to know why. Why is that? Is it because the interest rate is high? Is it because the leverage is high? Combination of both. If the interest rate is high and the leverage is high because it's a bridge loan, I don't mind a high break-even occupancy, because my point of being on the bridge loan is not to sit there and cash flow every month, patiently waiting. The point of the bridge loan is to get in, implement the business plan, and get out of the bridge loan. We don't want to be on bridge loans for any longer than we have to. When COVID hit in 2020, we refinanced out of all of our bridge loans right away. And we had no bridge loans on our books because we thought the world was going to end, and you don't want to have bridge loans on your books when the world's ending. Now we got through it. We have confidence in ourselves, in the market, in our portfolio, and we're proceeding to acquire property with bridge loans. And again, the point of those bridge loans is not to sit there and hang on to them and to milk cash flow. Bridge loans do not optimize deals for cash flow. The point is to implement your business plan efficiently, cost effectively, quickly, and then be able to refinance or sell with incurring minimal penalty on the bridge, right? That's what bridge loans are for.
Rob, what kind of terms are you getting on the bridge loans?
Yeah, good question. So bridge loans have, pretty much officially switched over to SOFR from LIBOR, and that's the index rate. And so typically bridge loans are floating rate products, and which means the interest rate adjusts every single month based on the index rate. And the index rate is SOFR, the short overnight financing rate or something like that. And it was, like I said, previously LIBOR, which you probably have heard more about. So SOFR today is 5 basis points. So SOFR is basically zero, but SOFR is going to track very closely with Fed funds. And so when the Fed raises rates, as they're projected to do this month, SOFR will jump. And SOFR should already start climbing now that we're in March. I'll actually check where SOFR is right now, because SOFR will start climbing in anticipation of the rate hike. SOFR is still 5 basis points, and it's been there for months. So if you say that SOFR is 5%, 5 basis points today, we're seeing spreads kind of in the mid threes for your loan spread. So that means you're paying SOFR plus a loan spread. So let's call it 3.5%. If your loan spread is 3.5%, SOFR plus 3.5% will be 3.55%. So I'd say bridge loans right now are in the mid threes, which is really great. You're able to get a lot of leverage, which is a good thing and a bad thing, right? Leverage cuts both ways. We're able to get a lot of leverage cheaply, and with pretty good terms as far as fees and stuff like that. The loan we're doing on this deal has a really good structure as far as fees going in, and really minimal fees going out. Just a 25 basis point financing fee upon exit. So there's no really expensive prepayment penalty and all that kind of stuff. We're really able to exit easily. So that's where the bridge loan market is today.
Rob, on your model, can you model a refinance, like what inputs we should be changing?
Yes. So the way to do that is, it's not super clear. So you modify the term of the going in loan. Instead of being 120 months, which is just, don't change it from 120. It breaks if you do, unless you're trying to do a refi. So if we're doing a refi, let's extend the hold period to 10 years, and then we're going to do a refi after 36 months, right? So our 3-year hold period goes up, and instead of selling, we refi, and now we're going to adjust this loan refi. I have this no here. It doesn't mean anything. I just put it there so people don't get confused. It's not a formula. It's not anything. You can put whatever you want there. So we'll assume, 75%, 4%. We'll maybe do 3 years of IO. And you choose the cap rate that determines the value that you refi at. So now if we just jump to the summary page, we have a problem. This model I might have broken for the refi. I had to fix something and it broke something else. That's why this is messed up, but I have my new model version. So if you want that, you can email me for it, or you can just download it, re-download it on our website. Either way, the new model works, which it should. So this is just totally broken, but that's how you do it. And then it will just clearly show, okay, you're gonna have a refi, you'll return some money here, you'll have your new cash flow stream based on the new loan, and then you'll sell. So sorry for it not working, and hopefully that doesn't confuse you, but the new model, it works again.
Okay, I have another question if you don't mind. So my current mentor, he's telling us to underwrite our bridge loans to a 5-year term with a 5-year IO. Why is that?
Because because typically bridge loans are 3 + 1 + 1, meaning
Right.
the initial term is 3 years, then you get 2 1-year extensions. The reason why he's telling you to do that is because it's going to upset investors the least. It's a conundrum. But it's very sloppy and lazy, because it's not accurate. Is that really how the deal is going to go down? No. In the first 3 years of your bridge loan, ideally you're going to implement your business plan and refi or sell. So the 5 years is lazy, and you're just trying to avoid conflict with investors. Your investors are asleep and they see the 5-year plan. They go, okay, great, I'm in. If you show them the 3-year plan, it requires more explanation and more work. So I think that's why he's saying that.
Okay.
Rob, can you talk us through, or talk me through anyway, the waterfall on this? Just because, again, I'm not that familiar with the spreadsheet either, knowing where to look for what.
Sure. So here is the waterfall tab. We don't have much time, so maybe I'll make a note. We'll do a webinar only on waterfalls. That'll be great. So I'll just do a very sneak peek, but who knows, in a month, in a year, we'll do a waterfall webinar. So, all right, the real short explanation is going to be a lazy one. So sorry about that, but this stuff, you pretty much, right, the advanced webinar that we'll have on this, I'll walk through this completely and it'll make 100% sense. But for now, you don't need to know anything about this. You just need to know that the waterfall is the methodology used to calculate the promote structure, which ours is an 8% preferred return. Up to a 15% IRR, there's a 30% promote. So between 8 and 15, there's a 30% promote. Above 15, there's a 50% promote. And the other wrinkle here is this 8% preferred return is cumulative and compounding and subject to return of capital. I'll show you what that means pretty quickly here. I'll just say that, here we owe the investors $973,000 in their 8% pref. We're only paying 5% in the first year. So we're actually short 300 grand. So where does that 300 grand go? It actually is added to the capital account of the investor. So you can see the investors started out with 12.2 million in capital. Effectively, their end of period capital account is 12.5 million. So now in year 2, the pref of 8% is calculated on this higher capital amount. So now the pref is $1 million, and it just keeps on going, right? Because we're not paying 8 in this deal, it accrues to the capital balance, and the pref goes up. And that's how this waterfall calculation is actually calculating the cumulative and compounding nature of the 8% preferred return, right? The deficiency doesn't just disappear, it's added onto and compounding. So that's really it for now. It's a way to calculate your waterfall structure. So everyone has to have one of these, but nobody really has to know how they work. At least most people. All right, we're gonna just jam through the rest of the questions and then we're gonna call it quits. So the question about what books can I read to learn more about what you're talking about? I think we were talking about financing back then when that question was asked, and I haven't read any good books about that, so I have no idea. I just learned by talking to lenders and just doing deals. So Mark's got a question on the pro forma rents. Do you factor in any rent growth in your pro forma input rents, assuming you have 20 to 24 month stabilization? All right, Mark, you caught us. Because there's so much rent growth happening in the short term, we are factoring in some growth. We're being kind of more optimistic on our pro forma because we're assuming a little bit of growth, right? We're not baking it all in, but we're assuming growth rather than adjusting this number. Right? Because this is kind of a terminal projection, right? We're just saying, okay, well, rents are going to go up 5% forever, right? Year over year over year. Instead, we're doing what's more realistic, right? If you look at Yardi projections, CoStar projections, there's a projection to go up a lot of rent growth happening in the last 18 months, and another 18 months, there should be elevated rent growth. And then it should go down and kind of get back to normal, right? That's kind of following the curve, the projected curve of inflation. So that's how we do that is, okay, we're going to get some good rent growth, obviously, mostly based on our business plan, right? We're being conservative and we should be able to outperform this still based on the projections. And then once we stabilize out in 24 months, we are going to go just a simple 3% thereafter. So yeah, that's a good catch. So I think your follow-up is, yeah, so I think that covers that. So I have a question about an underwriting course or any one-on-one coaching. I used to have an underwriting course, but then I struck a deal with my very good friend Hunter Thompson in his Raise Masters group. And so now Raise Masters, which I'm a proud member of Raise Masters, I'm in not that many masterminds or mentorship groups and stuff like that. And the ones I'm a part of, I'm kind of passive in, but Raise Masters is really amazing. Hunter's amazing. The materials that he provides as far as teaching is incredible. I mean, I've watched through it once. I'm going to keep watching through it and implementing the stuff. And then as an added bonus for members in Raise Masters, he's including my underwriting course in there. So it really is an amazing group. I've gotten a lot out of it. So I don't make any money. Hunter should totally be paying me for that commercial right there. But that's the answer about the underwriting course. And then I don't do any one-on-one coaching. Okay, cool. Right on time. We did a whole hour. I'm impressed. So thanks everyone for being on. If you have further questions, you can email me, and I will also, Ed, I will shoot you the new model. All right. Thanks again. Talk to you guys soon.
Thank you.